In this video, we are going to revise input tax credit. When we talk about input tax credit, the first thing which we should understand is what is the meaning of input, capital goods and input services. Let's try to understand the meaning of these two. Input means any goods other than capital goods which is used or intended to be used in the course or furtherance of business. Capital goods, any goods, the value of which is capitalized in the books of accounts, used or intended to be used in the course of furtherance of business. If you just combine input and capital goods, it covers all type of goods. That means any goods which we purchase, we will get ITC if it is used or intended to be used in the course or furtherance of business. Later on, government has put various restrictions. But if you see the plain language of input and capital goods combined together, any goods which you purchase, you will be eligible for input tax credit of that particular goods or service. Goods can be input, capital goods. Any revenue expenditure book, it would be inputs. Anything which is capitalized and you have taken input tax credit, it would be regarded as capital goods. So goods would be of two kinds, either inputs or capital goods, depending on whether it is capitalized or not. Input services. Input services means any service used or intended to be used in the course of furtherance of business. So the common language used for all these three is used or intended to be used in the course or furtherance of business. Now, what do you mean by input tax? Input tax, it starts like this. It says input tax in relation to a registered person. That means government is very clear at the inception saying that input tax would be eligible only to a registered person. Okay? Then it says any tax which is charged to him. To him here is registered person. So IGST, CGST, SGST, UTGST charged to him input tax would be available. Then it says any tax which is paid under RCM, that is also eligible for ITC. And while you are importing goods, in that you pay IGST. That IGST which you pay as part of custom duty, that is also eligible for input tax. But any tax which is paid under composition scheme will not be eligible for input tax. So input tax is purchase forward charge, whatever tax you have paid to your supplier. Purchase reverse charge, that is whatever tax you are paying under reverse charge. IGST paid on import of goods but does not include tax paid under composition scheme. This is the plain definition of input tax. And what is input tax credit? The credit of input tax. Credit, why is it called as credit? Because government is giving us a benefit. See, whenever you receive a cashback, obviously it is credited, right? Credited to your account. So similarly, the tax which you have paid on purchase is credited by government to our account and which can be used to pay output tax. So that's input tax credit. Any goods, any services, you are eligible for input tax credit if it is used or intended to be used in the course of furtherance of business. But there are some exceptions, that is blocked credit, where you don't get ITC. Now see what we have discussed. Till now we have covered these three. 1. Say suppose Mr. A has purchased raw materials. Any goods other than capital goods. Mr. A has purchased a machine. Any goods, the value of which is capitalized. Mr. A has taken a service. Any service used or intended to be used in the course of furtherance of business. What is input tax? It is input tax of I, C, S or UT charged to him, includes tax paid under RCM and includes IGST which is paid on import of goods, but does not include tax paid under composition scheme. This is what we have discussed till now. ITC provisions are there from section 16 to section 21 of Cgsp Act 2017. Now let's start the discussion from section 16. Let's begin. Now, When we talk about section 16, the first thing which you should understand is it provides for some conditions. There are some conditions attached to section 16. That means unless and until these conditions are satisfied, ITC would not be available. So it's mandatory to satisfy these conditions. Let's try to see what are the conditions specified in section 16. The first condition which is specified is you are in possession of an invoice, debit note or a tax paying document. You should be in a possession of that particular document based on which you are taking ITC. That's the first condition. What's the meaning of tax paying document? It could be your bill of entry, because when you import goods, you don't pay that tax to your supplier. You pay it through bill of entry. So that becomes your tax paying document. Or when you pay tax under RCM, you pay it through a payment challan. That payment challan becomes your proof for payment of tax. So you should be in possession of an invoice, debit note or a tax paying document. Fine. Thereafter, the second condition which is mentioned is you should be in receipt of goods or services. That means you have received the goods or services. See, be very careful. If you have not received the goods or services, in that case, you cannot take ITC. Say suppose, in this month, I received the invoice and in the next month, I received the goods or services. Then in that case, when can I take ITC? I can take ITC when both the things are there. One, I have the invoice. Second, I have received the goods or services. Once both the things are there, I can take input tax credit. Then the law does not stop here. The law has one more condition for us. Supplier has paid the tax. Supplier has paid the tax. So if supplier has not paid the tax, in that case, we will not be eligible for input tax credit. Now, this has been used aggressively by the department, and they have gotten conditions of GSTR 2A saying that if the supplier has not uploaded the documents in GSTR 1, in such cases, your ITC will be restricted to 10%. That rule 36, supplier has paid the tax. This condition is coming from here. Yes, and 2021 there is a proposal to add a specific point as well, that if the supplier has not uploaded, you cannot take ITC. But for your exams, the simple condition is supplier has paid the tax. And then finally it says you have filed a valid return. See, only in this valid return do you take ITC. You file a valid return under section 39, and the return which you file under section 39 is GSTR 3B. Once you have filed GSTR 3B, in that you can claim input tax credit. So 4 basic and primary conditions for taking ITC. Pehla, you are in possession of invoice or debit note. Dusra, you have received the goods or services. Teesra, supplier has paid the tax. And 4th is you have filed a valid return. 4 conditions satisfied, you can take ITC. But there are various sub-clauses in this particular provision where government tries to put additional conditions. Let's try to discuss all those. Say suppose you receive goods in lots or installments. Now if you have received the goods in lots or installments, the law says you can take ITC only after receipt of last lot or installment. Until and unless you don't receive the last lot or installment, you cannot take ITC. So ऐसा हो सकता है. This month I received 1000 units of invoice and 800 units are physically received by me, but 200 units are received in the next month. In such case, for the entire 1000 units, मैं ITC कब ले सकता हूँ? I can take ITC only in the next month when I receive the last lot or installment. Then the law also provides that depreciation under section 32 of Income Tax Act 1961 should not be claimed on the GST component. See, asset value पे तो आप depreciation claim करोगे ही, you should not claim depreciation on the GST component. If you have claimed depreciation on the GST component, in that case, you would not be eligible for input tax credit because you are claiming a benefit there and something which is not your cost, you are claiming a benefit. The moment you take ITC, it is not your cost. If it is not your cost, you should have claimed depreciation only on the basic value excluding tax. But now you are claiming on an entire amount. Government says no ITC would be given to you. Then, the government also provides for bill to ship to transaction. Now, what do you mean by bill to ship to transaction? So, suppose I have billed to Mr. B and he says that send it to Mr. C. Who can take ITC and when? Who can take ITC and when? The law says the person to whom you have billed, he can take ITC once the goods are received by the person to whom the goods were shipped to. That means, in our example, we had billed to B and shipped to C. So, who can take ITC? B, when the goods are received by C. And then, the law says, certain details are required to be there on invoice. There are 5 details which are required to be there on the invoice. What are those 5 details? Value, tax, description, GST IN of supplier and GST IN of recipient have to be there without any option. And lastly, place of supply. तो 5 condition कौन से हैं? Value, tax, description, GST IN of supplier and recipient, and finally place of supply, where is the goods or services consumed. 5 details there, you can take input tax credit. ठीक है? Okay. Thereafter, there is a time limit for taking ITC. There is a time limit for taking ITC. What is that time limit for taking ITC? The time limit for taking ITC is due date for filing September month return after the financial year or date of filing annual return, whichever is earlier. So say suppose I talk about August 2021. Now what is the financial year which is related to August 2021? So August 2021, obviously the financial year is 21-22. Correct? Due date for filing September month return after the financial year. After the financial year ends, which September will come? Sir, September 2022. And what is the due date for filing returns for September 2022? 20th October 2022. This is your cutoff date or date of filing annual return for this financial year. Now, it is very well possible that you have filed the annual return before this cutoff date. If you file the annual return before this cutoff date, then that date will be used. If you file the annual return after that, then in that case, this would be the last date for taking ITC. So, this is about time limit for taking ITC. Now, in case of debit note, the last date for taking ITC is based on invoice. It is based on original invoice, not based on debit note. For May 21, this is the applicable provision. For November 21, there has been an amendment. 1st Jan onwards, debit note, the time limit will be based on such debit note. That's the change which has happened. But for May 21 exams, in case of debit note, the time limit for taking ITC will be determined based on original invoice date. Okay. This was about time limit for taking ITC. Then there is one more condition. You recall 180 days. If the recipient fails to pay supplier within 180 days from the date of invoice, 180 days he fails to pay the supplier from the date of invoice. In such cases, the recipient has to reverse ITC in the month's return in which 180 days expires and pay it with interest. So he'll have to give it back to government, and while giving it back to government, he has to also pay interest at 18% per annum. Now this is a funny circumstance where supplier is not getting money, but government is taking away ITC and also government is charging interest on this. पैसा नहीं मिला supplier को, but benefit from this is to the government, where they take that ITC amount and that ITC amount into 18% per annum, they take interest as well. Now, later if you pay to your supplier, you can retake ITC, and remember, for this retake of ITC, ये time limit apply नहीं होगा. Which time limit? This time limit for taking ITC will not be applicable in such cases. Clear with this? Yes. So remember this 180 days. And remember, any tax which is paid based on an order under section 74, 129 and 130. Any tax paid based on an order under section 74, 129 and 130 ITC will not be eligible. क्या है 74? 74. Show cause notice in case of fraud, willful misstatement and suppression of facts. Section 125, search during transit. While the goods are moving, search during that time. And section 130 is confiscation of goods, jahan ownership gets transferred to the government. So in these three cases, you will not get input tax credit. So these are the conditions which are specified in section 16. Now, along with this, there is also rule 36(4), which says that if my supplier does not upload details of an invoice in GSTR1, again, if my supplier does not upload details in GSTR1, then for those invoices, my ITC will be restricted to 10% of the invoices uploaded by suppliers. 10% of the invoices uploaded by suppliers. For instance, say suppose my total ITC as per books is 100. This is as per books. Now my suppliers have uploaded to the extent of 80. This is coming in my GSTR 2A. So GSTR 2A is showing 80 rupees. How much of ITC do I claim in GSTR 3B? The ITC which I will claim in GSTR 3B will be 80 plus 10% of 80. 80 plus 10% of 80, which comes to 88. And what about that balance 12 rupees? Don't worry, that balance 12 rupees you can claim whenever that person has uploaded the invoice. So obviously government has restricted ITC based on invoices uploaded. The government is allowing a margin of 10%, and that 10% is not on invoices not uploaded. That 10% is on invoices which are uploaded by your supplier. So that into 10%, that's the eligible ITC which you can claim. Every month you keep track of this. इस महीने में how many uploaded, how many did not upload, then for those who did not upload, how much of ITC have you already taken for that, and then balance ITC which you have to claim. This is a monthly exercise which has started, and this is there in Rule 36(4) of CGST Rules 2017. So this was about section 16. Now, moving forward, let's move to section 17(5). Now 17(5) of Cgsp Act deals with blocked ITC, also called as blocked credits. Now when we say blocked credits, that means first you understand the basic concept. Even if these are used in the course or furtherance of business, you will not get ITC. Be very careful about that. See, how did we start this revision? Input services, capital goods. ITC is available if it is used or intended to be used in the course or furtherance of business. So something which is not in the course or furtherance of business, no ITC anyways. Now block credit, government is saying Though it is used in the course of furtherance of business, you claim that it is used in the course of furtherance of business, still I will not give ITC. These are basically consumption products where government denies ITC. Let's see what all is mentioned in block credit. The first thing which is mentioned in block credit is motor vehicle designed to carry passengers. And how many? Up to 13 passengers including driver. Including driver. A 13 including driver means 12 excluding driver. Throughout the law, government has used 12 excluding driver. This is the only place where government has used 13 including driver. दोनों का मतलब एक ही. 12 excluding or 13 including is same. Now, motor vehicle designed to carry up to 13 passengers, government will not give ITC. Aircraft, government will not give ITC. Vessel, government will not give ITC. On these three things, government will not give ITC. See, if you exclude these three things, still a lot of things are left, like designed to carry goods, special purpose vehicles or buses, which are motor vehicles designed to carry more than 13 passengers. In all such cases, ITC is available. Vapas. Buses, trucks which are used for transportation of goods or special purpose vehicles, you will get input tax credit. There is no bar. Plus, there are some exceptions in this also. Here, this 3 can also be claimed except. There is an except for these as well. That means in some cases, you can claim for motor vehicle up to 13 passengers. You can claim for aircraft. You can claim for vessel. What is that? Say suppose, I as a chartered accountant purchase a car. Will I get ITC? The answer is no. JKSha classes purchasing a car. Will they get ITC? The answer is no. Now, I am imparting motor driving skill. Now, when I am imparting motor driving skill, in such cases, will I get ITC while I purchase the car? The answer is yes. Remember, if I am in these 3 outward supplies, in that case, I will get ITC. First outward supply is if I am imparting motor driving skills. It could be imparting motor driving skills, it could be imparting navigation skills for vessel or aircraft. Second, if I am in the outward supply of transportation of passengers. Transportation of passengers means Indigo, SpiceJet or cab drivers who are running tours and travels business. In such cases, they will be eligible. And the last category is in case I use this motor vehicle for further supply. When I say further supply, there can be 2 cases. 1, I purchase a car and sell a car. Then I am eligible for ITC on car. Second, I purchase a car, give the car on rent and charge output tax. In such cases also I will be eligible for ITC. So 3 cases. Imparting motor driving skill, transportation of passengers, and if it is used for further supply. Now, in addition to these 3, for aircraft or vessel, there is one more, fourth one. Fourth one, if it is used for transportation of goods. This is separate. If it is used for transportation of goods, in such cases, it would be eligible. So, first 3 is for all, but transportation of goods. If I use aircraft or vessel for transportation of goods, then I am eligible for ITC on such aircraft or vessel. And remember one thing, in case of repair, maintenance and insurance, in case of repair, maintenance and insurance, ITC will be available if the vehicle is eligible. For instance, chartered accountant purchasing a car, not eligible. Repair, maintenance and insurance of that car, not eligible. But truck purchased by a factory owner, yeah, ITC will be available. Repair of that truck, yes. Maintenance of that truck, yes. Insurance of that truck, yes. ITC will be available. So be very careful about repair, maintenance and insurance. It depends on whether motor vehicle is eligible or not. If motor vehicle, aircraft or vessel is eligible, then repair, maintenance and insurance is also eligible. If these are not eligible, in such cases, repair, maintenance and insurance is also not eligible. Clear with this? समझ में आया? Yes. Then, the third aspect which is covering various services. Let's see. It covers outdoor catering. It covers food and beverages. It covers health insurance, life insurance, health service, cosmetic and plastic surgery, renting of motor vehicle up to 13 passengers or aircraft or vessel. This is covered by the third point. Now what is this? Let's try to understand. See, when we talk about outdoor catering, food and beverages, health insurance, life insurance, health services, cosmetic and plastic surgery, renting of motor vehicle up to 13 passengers, aircraft or vessel, all these are not eligible for ITC because these are basically consumptions. But say suppose I purchase food, sell food, will I be eligible? The answer is yes. Say suppose one of this is required under a law. A law requires me to do these for my employees. In such cases, will I get ITC? The answer is yes. If the law is providing for it, in that case, I will be eligible for ITC. So, two cases where these are available for ITC. One, when I am in the same category of outward supply, meaning I purchase food, give food. It can also be a case where hospital takes cosmetic and plastic surgery, being a luxury, hair transplantation. They take that from doctor. So, doctor will charge GST. Then this person, that is hospital, will charge to the patient. Can hospital take ITC of that GST which doctor has charged? The answer is yes. Because hospital is taking cosmetic and plastic surgery and giving cosmetic and plastic surgery. So if you are in the same category of outward supply, yes, you are eligible. But the end user of these will not be eligible for input tax credit. Clear with this? Be very careful about this renting. Let me give you a small and a very critical example of this. Now, I have a friend, Mr. A, he has purchased a car. He is giving it on rent to Cgsp classes for professor traveling. Mr. A has purchased a car, he has given it on rent to Cgsp classes. Will Mr. A get ITC of that particular car? The answer is yes. The answer is yes, because he is providing renting service. Okay. Will Cgsp classes get ITC on that renting service which they have taken? The answer is no, they will not be eligible for ITC. If they don't get for car, in that case, they will not get for renting of this particular motor vehicle. Clear with this? Yes. And remember one last thing. Say suppose I take a car on rent or a vehicle on rent and give that vehicle on further rent. Yeah. In that case, it would be eligible because same category of outward supply. Clear? Okay. Thereafter, you have one more point. The fourth point which is covered here is membership of clubs, health and fitness centers, and thereafter you have travel benefits to employees. Travel benefits to employees such as leave travel concession. In such cases also ITC will not be available. But say suppose it's a business travel, will ITC be eligible? Obviously people, ITC will be eligible if it's a business travel. But if it is for vacation of employees and consumption, membership of fitness center for employees, consumption. And then the law also says if it is obligatory, in that case ITC would be available. I don't know where travel benefits are obligatory, that is required under a law, meaning you will have to send the employees on vacation. Okay. So membership of clubs and travel benefits to employees on vacation, ITC will not be available. Okay. Thereafter, any goods used for personal consumption, in that case ITC will not be available. I'll give you a simple example. Say suppose, can I claim this ITC on this shirt saying that I use it only for lectures and I want to claim ITC on that? The answer is no. Personal consumption will not get ITC It's covered by block credit. Then any goods on which tax is paid under composition scheme. If tax is paid under composition scheme, that is tax paid under section 10, again ITC is not eligible. Thereafter, the law also provides for any case where goods are lost, destroyed, stolen, written off or disposed by way of gift or sample. So in such cases also you will not be eligible for ITC. Remember, disposed as gift or sample, then ITC is not eligible. Now remember, the law uses the word destroyed, does not use the word damaged. If the goods are damaged and thereafter you can sell it, in such cases obviously it does not fall under the category of block credit. ITC will be eligible. Clear with this? Okay. Thereafter, any goods or services purchased by a non-resident taxable person except goods imported by him. Except goods imported by him. See, whatever he is importing, obviously he will get ITC of Cgsp which he has paid on import. Otherwise, a non-resident taxable person will not get even a single rupee of input tax credit. That is not permissible. Okay, this understood. Now, thereafter, the law also provides for very important segment. Now, see what happens in case of construction or works contract. See, whenever you talk about construction or works contract, any goods or services which is used for construction of an immobile property or works contract for construction of an immobile property, ITC will not be available. But if it is used for plant and machinery, then ITC will be available even if such plant and machinery is immobile. And then government says plant and machinery excludes three things. Plant and machinery excluding three things. That means on these three things, again, ITC will not be eligible. Now the question is, what are those three things which are mentioned in the law? The first thing which is mentioned is civil structure, that is land and building. Obviously, you will not get ITC. Civil structure. Second is pipeline outside the factory. And the third one is telecommunication towers. These three things will not be considered as plant and machinery. So for these three, if you use any goods or service, then ITC will not be available. Clear with this? Yes. The construction of an immobile property, any goods or service or works contract will not get ITC. But say suppose I am taking works contract, giving works contract service, in such cases I will be eligible for ITC. Say suppose I purchase steel and sell steel, obviously I will be eligible for ITC. And what about some revenue expenditure which are debited to profit and loss account? Any revenue expenditure which is debited to profit and loss account, that is small repair of the building, a repair of elevator, in such cases ITC will be available. So the restriction is basically in case of capital expenditure, and the law very clearly says construction would be something which is capitalized. So be very careful. If it's a small revenue expenditure, government does not have any objection, you can obviously take ITC. But say suppose you are making one extra floor, is it a case where it's a revenue expenditure? No. Obviously, in such cases, ITC will not be available. So, what have we discussed? We covered block credit. Just before this, we covered section 16. So, this is the ambit which we have covered till now. 1. Section 16, all the conditions, and then block credit. Now, the next discussion in this phase is section 17, apportionment of ITC. Very important discussion. Listen to me very carefully. There have been some changes in this. I mean, obviously it was there for November 20 as well. Let's have a look at the changes which has happened in this particular segment of Section 17. Okay. Now when we talk about Section 17, Section 17 basically now deals with apportionment of ITC. Now when we say apportionment of ITC, let's try to understand what cases can be covered under this. Now, we'll start with some basics. See, my output is exempt. If my output is exempt, will I get ITC? Sir, if my output is exempt, I should not get ITC. Okay. If my output is taxable, sir, if my output is taxable, anything in relation to that ITC should be available. Okay. If my output is export, or if my output is sale to a SEZ, which is regarded as zero rated supply. Sir, if your output is a zero rated supply, in that case, you will be eligible for ITC. Plus, you will also be eligible for refund. So, obviously, any goods or service which is used for zero rated supply is eligible for ITC. And what if it is blocked? Sir, if it is blocked, then ITC will not be available. So, let's try to figure out the entire ambit of this. First, input and input services. When you talk about input and input services, the first thing which you should understand, something which is used for exempt supply, then in that case, ITC will not be available. Exclusively used for exempt supply, ITC is not available. Exclusively used for non-business purpose, again ITC is not available. If it is used for taxable supply or zero rated supply, obviously ITC will be available. What if it is a blocked ITC? Sir, if it is blocked ITC, obviously you will not get ITC. Now there are a lot of things which are commonly used, like say suppose I am manufacturing both taxable goods as well as exempted goods, and I use a machine which is a packing machine which is used for both. In that case it is common. Now that is a common capital goods. We will come to that in some time. At present our discussion is only on common input and input services. For example, there are some raw materials which are used for both taxable and exempt supplies, or chartered accountancy service which is used for the entity, entire business, which includes both taxable and exempt supply. The rent of that premise where both taxable and exempt goods are manufactured. In such cases, the question which arises is, what would be the treatment of such common input or input services? Let's see. Balance credit will be called as common credit. Now this common credit, first we have to find out how much is relatable to exempt supply. So whatever is relatable to exempt supply, you will not get ITC. How do you find out how much is relatable to exempt supply? Simple. Common credit into E by F. E is exempt turnover, F is total turnover. E is exempt turnover, F is total turnover. In such cases, to that extent, ITC will not be available. This has to be done on a monthly basis. Every month you have to do this, and one final yearly calculation has to be done to check whether there is any errors. So, common credit into E by F, you will do this on a monthly basis depending on the common credit of that month, and E of that month, F of that month. Say suppose, sir, for 1 month I don't have data, then the law says use previous month data but derive this relatable to exempt supply. Then say suppose it is used for non-business purpose as well. You have to do a reversal of 5% of common credit. But do this non-business purpose reversal only when question clearly says that there is a usage towards non-business purpose. Don't apply it blindly on all the sums. Only when question specifies. See, if question clearly says how much is non-business purpose, then apply that. Then don't use this 5%. If question says that it is used for non-business purpose as well, then 5%. Question is silent. Please don't start applying this 5%. Then just do relatable to exempt supply and balance will be available as ITC. Balance ITC available. Clear with this? Yes. Now, most important thing is what is the meaning of E. I've seen a lot of people struggle with this E. What is E? See it very carefully. See, if E is more, first understand the logic. If exempt supplies are more, ITC will be less. Correct? Correct? Yes. If exempt supply are less, then ITC which I will get is more. Okay. Now the question is, what is E? Listen to me very carefully. E means exempt supply. See, exempt supply covers various things. Exempt supply covers something which is exempt, something which is nil, and something which is non-taxable supply. Non-taxable supply, that means alcoholic liquor and pipe products. First of all this is included in E. Correct? Okay. Then it covers supply where recipient is to pay tax. Supply where recipient is to pay tax. That means a case where the recipient would be required to pay tax and I as a supplier will be considered that particular portion as E. Because I am not discharging output tax on that. Government says consider it as E. Simple example. GTA to unregistered person. Is it exempt? Yes sir. It will be E. For GTA this is E. Then GTA to registered person, where GTA is not paying tax, GTA to registered person has to pay tax. In such cases, for GTA, this is considered to be E. So, E is not just exempt supply, it also covers supply where recipient is to pay tax under reverse charge mechanism. Correct? Till here things are very simple. Then the issue arises. Why? Because then the law says E excludes 1, 2, 3. There are 3 things which are excluded from E. First of all, these are exempt but not considered as E. Understand one fact very clearly. All these 3 are exempt supplies but not considered as E. That means government is giving us a benefit. Hey, did you understand this? These are exempt but not considered as E. First one. Interest on loans, deposits or advances other than interest earned by banks and financial institutions. So banks and financial institutions earning interest, that is exempt and that will be considered as E. But a Marwadi, a Gujarati or a particular person earning interest from loans or from fixed deposit, that interest is exempt but will not be considered as part of E. If it is not considered as part of E, that means it's advantage to us. Clear? So to that extent, we don't have to do reversal of common credit. Then the second thing which is E but not considered as part of E. Second one is negative list. Negative list other than land and building. When I say other than, that means that other than part will be included. Other than land and building. So land and building, negative list land and building which is constructed property being sold or sale of land. In such cases, it will be considered as E. So, all other services which are there in negative list, like actionable claims, employee providing services to employer, fees taken by a court or tribunal, all these will not be considered as part of E. But land and building which you sell after it is constructed, it will be considered as E. Okay. And then the last one is vessel. Vessel. Transportation of goods from India to outside India. See this very carefully. Transportation of goods from India to outside India. When I say transportation of goods from India to outside India, this is exempt. This is exempt, but it will not be considered as E. That means vessel operators are not required to do reversal of ITC for this. Very smartly drafted provision. Vessel operators, India to India is taxable. India to outside India is exempt. Outside India to India is taxable. India to outside India, which is exempt, will not be considered as E. If it is not considered as E, in that case, no need to do reversal for this particular part. Clear? Listen to this twice. Very important. Okay. Then the law has also said that for land and building, the valuation will be based on stamp duty value. And for securities, the valuation will be 1% of the sale value. 1% of the sale value. These are the two things which you should keep in mind whenever you are reading E. Correct? But remember one thing, F includes everything. When I literally say everything, I mean it, that everything, every supply will be considered. See, those which are excluded in E, those are also considered as part of F. For your exams, this is what you have to follow. In practical life, you can do whatever you want. You can take legal positions, but when it comes to examination, follow the method which is being prescribed by institute. So, for F, please consider all these things as part of total turnover. A, clear? Yes. This was about common credit calculation in case of input and input services. I told you, you have to do this on a monthly basis, and thereafter you'll have to do a yearly computation to check whether there is any excess ITC taken or short ITC taken. Say suppose you have taken excess. If you have taken excess, then reverse it. And interest at 18% per annum from 1st April, that is after the financial year. Say suppose you have taken less. You have taken less ITC, then please take it. But the due date for taking ITC, don't forget. Due date for filing September month return after the financial year, or date of filing annual return, whichever is earlier. So be very careful about this particular point in input and input services. Okay. Now let's talk about capital goods. Another very important discussion. See, when we talk about capital goods, the first thing which you should understand. See, capital goods which are used exclusively for exempt supply. Capital goods which are used exclusively for exempt supply. Will you get ITC? No, sir. Capital goods used for exempt supply exclusively? No. Used for taxable supply? No. Used for both, which is called as common credit, like packing machine or any other machine which is used for making taxable supplies as well as exempt supplies. In such cases, how much of ITC will you get? First, you can take full ITC in the month of purchase. Whenever you purchase it, you take full ITC in the month of purchase. Step 1. Step 2. This is called as TC, common credit. Then divided by 60. TC you divided by 60. This is called as TM. This is credit attributable to 1 month. Find out this. Now once you find out this, there might be lot of assets. This is only for one capital goods. There might be lot of capital goods. For all capital goods, find out TR. TR is nothing but sum of all TMs. TM is for individual capital goods. And TR is for all taken together. Then what will you do? Then you will calculate reversal on a monthly basis. Reversal on a monthly basis is TE. Reversal is TE, that is TR into E by F. TR into E by F. This has to be done on a monthly basis. Clear with this? Yes. So you keep doing this reversal on a monthly basis till the life of the asset. Now one question would come, which is, how did we get this 60? Simple. Life of all capital goods in indirect taxes is considered to be 5 years. And when we say life of all capital goods is considered to be 5 years, 5 years is nothing but 16 months. So you continue your reversal for 60 months. Sir, in between if I sell the capital goods, or in between if there is a change in usage, that will also come. First you have understood this common credit. First you take full ITC, divide by 60, do the reversal. And remember one thing, whenever you do the reversal, that reversal is with 18% per annum interest from the date of taking ITC till the date of reversal. That has to be computed on a regular basis. That's one of the reasons where most of the industry players don't take ITC on common credit if the amounts are small. Okay. Now, this was about capital goods. What happens if there is a change in usage? Let's see. If there is a change in usage, again a very important thing, change in usage. What can happen? When I say change in usage, see, we are only speaking about capital goods. Law has provided for it. Say suppose earlier it was used for exempt supply. Now it is being used for taxable supply. Earlier used for exempt supply. Now it is being used for taxable supply. Will you get ITC now? The answer is yes. So earlier exempt supply, now taxable supply, you will get ITC. How much? Tax paid minus 5% per quarter or part of the quarter. Tax paid minus 5% per quarter or part of the quarter. This much you can take ITC. Why are you removing 5% per quarter? Because to that extent it was used for exempt supply. To that extent it was used for exempt supply. So if I were to break this, tax paid you get ITC and 5% per quarter you reverse. Tax paid you get ITC, 5% per quarter or part of the quarter you reverse. So net you take tax paid minus 5% per quarter or part of the quarter. Okay. What if earlier this machine was used for taxable supply? Now it is used for exempt supply. Earlier it was used for taxable supply. Now it is used for exempt supply. That means you have taken ITC earlier. Then sir, here we will have to reverse ITC. Here we have taken ITC. In this we will have to reverse ITC. How much? The law says proportionate to remaining life of capital goods. Proportionate to remaining life of capital goods. And this is what you will reverse. And remember one thing, whenever you do proportionate to remaining life, it is based on monthly basis. That means life is considered to be 60 months. So based on that 60 months, you have to first find out how much life has been exhausted. The balance has to be reversed. Clear with this much? Yes. So exempt to taxable, you get ITC. Taxable to exempt, you have to do a reversal. Third case is interesting. This is where we make a mistake. See this very carefully. Earlier it was used for taxable supplies. Now it is being used for both taxable supplies as well as exempt supplies. See this. Earlier used for taxable supplies. Now it is being used for both taxable and exempt supplies. First, have you already taken ITC? Yes, sir, we have already taken ITC while we purchased it. Okay. Now what you will do? Now sir, we will start reversal. How will you start reversal? You will directly start reversal. Whatever ITC you had taken, ITC taken divided by 60 into E by F. And this you will do for the remaining life. This you will do for the remaining life. I'll give you an example. For 6 months, you had used it for taxable supply only. Now it is being used for taxable and exempt supply. Now when it is being used for both taxable and exempt supply, what would you do? You will start reversal. But first you find out how much is relatable to 1 month. ITC taken divided by 60 into E by F. Do it for remaining life. Remaining life of that asset is 54 months. क्योंकि 6 महीना तो पहले यूज कर लिया. 54 months is the remaining life. For that 54 months, you will have to do the reversal in the same fashion. So you found PM into E by F. So that means ITC taken by 60 into E by F. Clear? So you will start reversal. Correct? Okay, sir. Understood. Now the last case. See this very carefully. Earlier used for exempt, now used for both taxable and exempt. See, there can be other two cases, but they are not given in the law. We'll be sticking to this revision lecture. In full lecture, we discuss all the possible cases, but now we'll stick to exam point of view. Exempt now being used for both taxable and exempt. See, earlier when you purchased it, it was used only for exempt, so you have not taken ITC. So step 1 will be to take ITC. Take ITC of the tax paid. Then for the period for which you have used it for exempt supply only, reverse 5% per quarter or part of the quarter. See, this seems to be 2 steps, but see, these 2 steps are nothing but this. Tax paid minus 5% per quarter. You can see this. This one and 2 are just break of tax paid and 5%. So first you take ITC of full and then you will reverse 5%. Sir, why do you do this? You can take tax paid minus 5%. Nah, I'll tell you the reason. Then you do the reversal of monthly basis. Monthly reversal when you do, in such cases, you will ITC divided by 60 into E by F. What you would be doing is ITC divided by 60 into E by F. Now this ITC which we are talking, this is coming from step 1. Did you understand this? See, earlier when the law started, we used to do as what you said. Tax paid minus 5% divided by 60. That's what we used to follow earlier. Then there was an amendment for November 20 which said tax paid, first you consider that. Reversal 5% you do for the balance period. Whatever you have considered as ITC, divided by 60. For instance, when I purchased this, I paid 60,000 as tax. Can I take full 60,000 as ITC? The answer is yes. And then I will divide this 60,000 by 60. Okay, clear? So then, once I do this, I start reversing. Yes. Yes. So this is about change in capital goods. Now, we are left out only with 18, 19, 20, 21. 19 will be discussed in job work, where job worker, how much ITC can take. 18 is something which is critical. 20 is input service distributor, again a simple provision. See this. When we talk about 18, section 18 deals with special circumstances. So when we say special circumstances, what cases are covered? The law says, first, if a person shifts from composition to regular scheme. Think. A person is shifting from composition to regular scheme. That means he is going to pay taxes to government? Yes. The moment you say he is going to pay taxes to government, government says, you are going to give me something, I am also going to give you something. मैं भी तुमको कुछ दूंगा. What will government give? Government would give ITC on stock as on the immediately preceding day from the date of shift. Immediately preceding day, whatever stock you had, you will get ITC. Stock of inputs and stock of capital. For inputs, you get ITC of whatever you had paid GST on such inputs. For capital goods, you get tax paid minus 5% per quarter or part of the quarter. This is what you get. Correct? Now imagine regular to composition. If a person moves from regular to composition on this stock, he will have to lose ITC because he had taken ITC while he was in regular. Now he is moving to composition. And remember, regular to composition is possible only on 1st April. Composition to regular anytime. So on stock of inputs, you will have to reverse full ITC taken. Whatever ITC you have taken, you have to reverse it. On capital goods, you will reverse proportionate to remaining life of capital goods, which is calculated based on remaining life in months. So total life is considered to be 60. Now, government has put one condition. What is that condition? On these, if the invoice is older than 1 year, then you will not get ITC. If the invoice is older than 1 year, then you will not get ITC. This condition is not applicable for regular to composition. See, whenever you have to reverse ITC, that means give back ITC to government, this condition does not apply. This condition applies only when you have to take ITC. When you have to take ITC, government says, if the invoice is older than 1 year, you will not get ITC. Okay. Now, what would happen if a unregistered person becomes a registered person? Again, he will get ITC on the stock, on the immediately preceding day, but only of inputs. This is the difference. For composition to regular or regular to composition, input and capital goods both are considered. But unregistered person taking fresh registration only on stock of inputs on the immediately preceding day, that is based on effective date of registration. Now sir, what is the meaning of effective date of registration? Now, effective date of registration, if I apply within 30 days from the date when I am liable, then effective date of registration is when I was liable to register. If I apply after 30 days from the date when I was liable, effective date is date of grant of registration. If I voluntarily apply for registration, effective date is date of grant of registration. So based on this effective date, previous day stock of inputs, you can claim ITC. Be very careful. For unregistered to registered capital goods, you don't get ITC. And then you have registered person becoming an unregistered person. This we will take up in registration chapter. When you are cancelling your registration, what is the impact? Obviously, you understand that in case registered person becomes an unregistered person, he will lose ITC. He will have to reverse ITC. Method is same, but just tax paid, tax on transaction value is compared and whichever is higher is taken. Okay. Now what happens in case of sale of capital goods? Say suppose there is a sale of capital goods. In that case, do you have to pay tax? The answer is yes. In case of sale of capital goods, you will pay tax on transaction value or tax paid minus 5% per quarter or part of the quarter, whichever is higher. The government wants more tax, but remember, bowls, dies, jigs, fixtures, some small assets which are scrapped out. In such cases, you can pay tax based on tax on transaction value instead of doing all this computation. That is one relief which is available in case of sale of capital goods. Say suppose there is a merger, amalgamation, demerger, whether you can transfer ITC. Yes, there is a form ITC 02, sale of business or merger or demerger. You can file a form called as ITC 02 and you can transfer the ITC to the other person. That's obviously permitted in the law. Say suppose there is a demerger, how will you divide it? In case of demerger, you will divide it based on the assets transferred to each of the transferees. Based on assets transferred to each of the transferees. And say suppose you have different registrations in different states. For each state, check assets transferred for each registration. Based on that, you transfer the ITC. And don't forget one important thing. IGST, CGST, SGST, which is there as ITC, you can transfer it in case of demerger based on the assets transfer. So it depends on the assets and based on that you can divide it amongst the demerged entities. Merger, sale or amalgamation, this issue does not arise. Okay. Whatever is the ITC, that you will transfer it to the transferee. Clear with this? Yes. So composition to regular, regular to composition, unregistered to registered, sale of capital goods and merger, sale or demerger. What's the case? Now, one special provision which is there in section 17 in case of banks and financial institutions. They have two options. One, they can follow that reversal of common credit calculations, that is E by F, or they can reverse 50% of ITC on inputs, capital goods and input services. So this is the second thing for banks and financial institutions. And trust me, most of the banks in India use this 50% easy, plus they get more ITC. Sir, how will they get more ITC? Mostly main income of banks and financial institutions is interest, which is an exempt supply. So if they were to do this E by F calculation, they'll have to pay more. And remember one point in this banks and financial institution, say suppose there is a transaction between distinct persons, then you don't have to reverse 50%. That's a benefit where 50% reversal will not apply if the transaction is between distinct persons of a branch, like HDFC Bank Bangalore providing services to HDFC Bank Mumbai, then there will not be a need to do this 50% reversal. Full ITC can be taken. Yes,